Good afternoon. Thank you all very much for coming. Just so you know, I'm Ted Thompson. I'm a research fellow here at Policy Exchange, responsible for our financial services programme. And I'm particularly pleased to welcome Matthew Bishop and Michael Green. Matthew is the New York bureau chief of The Economist, and is their chief business writer, and Michael is an independent economist and author. And they both previously wrote Capitalism together a few years ago, and they've now followed it up with their latest book, Road from Ruin. It's a particularly interesting time for us in politics, trying to work out where exactly the growth is going to come from. Personally, for myself and amongst Policy Exchange, we're very much in favour of the spending cuts, trying to rebalance the economy sensibly, rebalance the deficit, and trying to have those right ideas about how we can move the economy forward and how we can have this sort of suitable economic model is really important for us. The financial crisis has given a lot of food for thought about what sort of reform should happen, how we should move forward, and it's given a lot of ammunition to a variety of other economic models away from capitalism, who think that we should try and limit our innovation, limit our growth, and we should kind of go back to just producing things like we did once upon a time. So I'm particularly pleased that we're going to hear more from the authors today about how they think we can move forward with capitalism, embracing the best bits about it that still work, but at the same time finding ways to tweak those bits that obviously failed in the financial crisis, and hopefully ensuring that we've got a positive outlook for ahead. But I'll leave you all to tell you more about it.
Great, thank you very much, Ted. I'm Matthew Bishop, one half of the duo that's going to be speaking to you, and we're going to tag team a couple of times before going over to discussion. I want to start by just talking a bit about the background to this book. It was born at the launch of our previous book, Capitalism, which we, with impeccable timing, managed to bring out about 3 days after Lehman Brothers went bust. Which, in terms of a book about giving and the wealthy, how that we actually initially had the subtitle "How the Rich Can Save the World." Maybe marked us out to be perhaps the worst timed authors in the history of the world, actually. But as we sat there thinking about, our work being in ruins around us, we tried to understand. We found ourselves talking over a few drinks about what actually has happened. Why did we not see this coming? What are the implications, firstly, for capitalism, which is, we concluded would actually be more important in future, as actually for a number of reasons we can go into, and which I think the growing interest in big society ideas plays into. But secondly, what did it mean for our views on capitalism and basically the dominant economic and political theory of the previous quarter of a century or so? I'd been very much at the coalface reporting for The Economist on Wall Street and many of the people who brought us the collapse of capitalism in September 2008. Previously, I'd been in London the last couple of years of the previous Conservative government, covering economic policy and particularly Labour's conversion to the conventional wisdom of the day. And my first stories in New York had been the creation of Citigroup through this mega merger that undid the separation between investment banking and commercial banking and brought us the too big to fail institutions that we were all to come to love during the past couple of years. And then the collapse of long-term capital management, a huge hedge fund that nearly brought the financial system to its knees in a very similar fashion to what happened when Lehman Brothers was allowed to fail. And so we just started chewing over what had gone wrong and felt actually that there were some really big questions that we had that we wanted to understand. And the book is the result of that we thought we would look back throughout history, all the previous examples of notable bubbles, crashes, long recessions, depressions and so forth, right the way back to tulip mania and the South Sea bubble, and through things like the Great Depression in the 1930s, and then more recent examples like the dot-com bubble, the first dot-com bubble, maybe going through a second one, but also the collapse of Enron, long-term capital and so forth. and then some of the Asian crises and Mexican crises and other things in the developing world. And we tried to draw some common themes. Overall, the message of the book was that toxic assets are what we're talking about, but toxic ideas were actually rather more important, and there had been a lot less discussion of the ideas that had brought us to this catastrophic moment. For me, those ideas were really encapsulated in the person of Alan Greenspan, who was the chairman of the Federal Reserve for a very long time and became such a central figure in the mythology about how our economy was performing so well that John McCain, when he was running for the presidency in 2000, famously said if Alan Greenspan were to die, we would have to put him up in a chair and carry him around like in Weekend at Bernie's. He became that sort of reassuring figure, and I went to interview him on a number of occasions and was always, as a journalist, probably more terrified of being found out as an intellectual fraud by him than anyone I'd ever been terrified of meeting. And you know, you could have led into this room through this dark corridor, you're sitting in a big chair and you're perching on the end of a chaise longue, trying to ask these questions and feeling a complete idiot as you speak. And yet, with hindsight, you know, this man who probably knew more about the available data, more about the economy than anyone in the world, was just fundamentally wrong on the big calls about how the financial system operated. At the very heart of that was his belief in a sort of cod version of something called the efficient market hypothesis, which was produced by the academic community a quarter of a century before, and so kind of proved Keynes's famous point that practical men are slaves to some defunct economist. And Greenspan was very much a believer that markets were essentially efficient, that we could rely on markets to do our job, that the market price, the current market price, was the best indicator of real value of economic activities. And so, although he famously in December 1996 wondered aloud whether high share prices were the result of irrational exuberance, he backed away from that conclusion and never really raised it again. He just accepted that the share price was the right price and left it alone. Now, that idea went hand in hand with another idea that I guess became most famously encapsulated by Gordon Brown with his "we will abolish boom and bust" comment, but which many respectable people, including the current chairman of the Federal Reserve in America, Ben Bernanke, believes, which is that we were in a period called the Great Moderation, where central bankers had figured out how to manage the global economy so that we would never have out of control inflation, unemployment in a significant way. Again, that we were on this sort of period of steady, predictable, low unemployment, low inflation growth. And these ideas are all wrapped up together, and it turns out that the more you dig, the more we have created a huge edifice on those intellectual assumptions about essentially the perfect behaviour of markets. And it runs through the fact that central banks kind of believe they can tweak the interest rate and it will immediately move through into credit being made available in the marketplace. It goes to how we reward investment managers according to beating the market in the short run. It goes through to how we reward people who run companies, who we reward with shareholder value creation that's based on very short-term measures of shareholder performance and in fact encourages incredibly short-run behaviour. Anyway, so we think that there needs to be now a sort of root and branch rethinking of many of the assumptions that we have about how the capitalist system works. Now, we're not saying throw out the market by any means, or throw out financial innovation. We're very pro-market, pro-financial innovation, but we actually think that the time has come to tap into many of the new economic ideas that take a more sophisticated view of what motivates our behaviour, how humans behave, how institutions behave, and to try and find ways to incorporate that into our policy making. And it's good to hear David Cameron talk about the work of Dick Thaler and Nudge, and have a Nudge unit established, because there are insights in that work that I think can inform policy. So we wrote this book initially for an American market because I was based in America, and we felt that in a way that there was a more pressing need to address the problems in America because it still dominates the global capitalist system, and there was clearly an appetite to get on and do some reform there. And we even subtitled it How to Revive Capitalism and Put America Back on Top, a title which you will notice we've not tried to push in the version of the book that we're pushing here. But the change is more than that. What we found in America was that the book tapped into a mood that was very anti-intellectual, that there was a sense in which Americans reacted in a way that now people are calling a crisis of American democracy by moving to the extremes. That on the left, the idea that the entire crisis was the product of a conspiracy of bankers, as encapsulated in Simon Johnson's book, 13 Bankers. It really took hold. The bankers were all to blame, they were all greedy, they should all be strung up. And on the right, I think there was a sort of denialism that they'd been so shocked by the fact that it had been them that had been responsible for having to nationalise Citigroup and AIG, that they kind of went into a denial mode and said that the whole fault of the crisis should be laid at the door of government. That even I've heard people at the Manhattan Institute describe Ronald Reagan as the first American state capitalist. That's an analogy that boggles my mind. And that what you want to do is get the government completely out of the market. So rather than what might be seen as an obvious statement that we should be learning why both sides failed and how to improve the performance of capitalism and of the regulatory government system, we've had this sort of blame game. And in the middle of this massive piece of legislation was pushed through, the Dodd-Frank Act, 2,000 pages long, unreadable, the result of all sorts of things that we in Britain think are most awful about American politics, the role of money, corrupting the system, the pork barreling in smoke-filled rooms and so forth. And a lot of tough decisions have actually been punted to the regulators to look at. Some very basic reforms like getting rid of certain regulators, merging them together, have been not even considered because they would have meant shutting down a very promising revenue stream for congressmen because they oversaw the particular regulatory unit and so didn't want to shut it down. So it's a terrible mess. And it left us feeling, okay, there is no appetite to really tackle the hard issues in America. And then, lo and behold, over here, this bizarre result in our election last year has produced a government which it does seem, because it has to bring together these two parties with their different traditions, and does seem to also have brought together people who understand that we're in a real mess that only hard thinking is going to get us out of. Seems to have produced an unexpected moment where there's an appetite for ideas, for thinking stuff through, for doing the interesting reforms that could be done. And our feeling was that this is a moment where Britain, if it does the right things, has an opportunity to become the intellectual leader for the world again, the role model for how you reform the state and how you reform capitalism in the aftermath of this crisis, which has revealed deep intellectual flaws in the way we've been going about things. And so we've rewritten the book very thoroughly, completely new introductions and conclusions and lots of other parts of it, as an agenda for this government. And we're hoping that it will actually stir up much more debate here than there's ever been in America, where, as I said, I think they just left themselves with a bit of a dog's breakfast. Just before I hand over to Michael, it seems to us that there are two areas where we should focus our discussion today. We're going to put to one side the conversation about the timing of the cuts and things. I think we feel that clearly the state had got too big and needed to be brought down. We're worried about, from an economic perspective, whether the timing of the cuts is actually going to make the transition to the smaller state rather more painful than it needs to be. But we understand the political strategy means that probably you have to do the hard stuff early and hope that the electorate's forgiven you by the time you go back to the election in 5 years' time. We want to focus on the other two parts of the component. One is the big society, the other is the reform of the financial system, where we have these two inquiries, one looking at the banking system, one looking at the long-termism question. And just as I hand over to Mike, our concern is that on the big society, that there's an awful lot of woolliness around on something which ought to be actually very crisp and serious thinking. And on the banking long-termism issue, our worry is that most of the ideas that are being talked about for the banking system, history tells us won't work. And that actually by focusing on the banking system, we're focusing on the symptoms of the problem, not the cause. And I'm going to hand over to Mike to talk a bit about that.
Thank you, Matthew. Afternoon, ladies and gentlemen. So one of the things we did in the book was really sort of dig into the history of financial crises past and try and see what we could learn. And what was really surprising was the amount of déjà vu. I mean, one thing that we saw in this financial crisis that you saw in many others in the past was that as soon as there was a crisis, the regulators put a ban on the short selling of shares, which didn't work then, didn't work this time around, and our regulators have admitted. So it seems straight to this, there are lots of patterns running through the history of things that we've tried in the past that some have worked and some haven't. So what I want to do is talk about what we could describe as 3 blind alleys for reform of the financial sector that we need to not go down. I suppose the first of those is, I think very soon after the crisis, we saw the media desperately trying to explain what CDOs were, how securitization worked, and all these kind of things. So financial innovation was something the company was trying to catch up with, and took a lot of the blame very early on after the crisis. And we had Adair Turner talking about socially useless financial innovation. George Soros was talking about creating a regulatory body like the FDA to regulate new financial innovations lest they be dangerous. And I think what we found looking back in history, of course, was that there's a very, very strong link between financial innovations and bubbles. In fact, there's a very strong link between innovations of all kinds and bubbles. It can be financial innovations like securitization. It can be financial innovations like paper money. It can be technological innovations like the dot-com. It can be technological innovations like the railway. So I think that tells us 2 things. The first is that bubbles will always be with us. For as long as we're innovating, what that's doing is generating new information into the market and potential new value. And what the market is trying to do is work out the value of those innovations. And what we find happens quite a lot is that our expectations of those things overshoot. And I think what's very clear is that overshooting of expectations seems to be a pretty natural human characteristic. And you'll actually find an explanation of why in both the works of Adam Smith and John Maynard Keynes. Adam Smith talked about the problem of overweening conceit, our tendency to estimate that we're going to be more successful than we are. And Keynes talked about these being animal spirits. So these are sort of fundamental characteristics we have as humans. When we get new information, there will be a tendency to get a bit irrationally exuberant. So one thing I would say is behavioural economics didn't start with Richard Thaler or any of the others, it started with Adam Smith. And that insight I think is important in helping us understand why bubbles happen and why bubbles are always going to be with us. So trying to say we'll never have boom and bust was an exceptionally foolish thing to say. So the second thing that tells us is, I feel, is that if we try and stifle and stop innovation, then there's a huge cost to that. We have to accept innovation and learn how to work with it rather than stifling innovation, because without that we won't have the drivers of our future prosperity. And I'm greatly, greatly worried by the work of Nassim Nicholas Taleb and his Black Swan, which I think describes a future where we go around terrified of the world, lest one of his black swans is hiding around the corner, and trying to de-risk our economy is definitely something that's going to put us on the road to ruin. So that's the real first lesson. Some of the financial innovations may have blown up, but blaming the innovations and trying to stop innovation would be a huge error. The second response to the crisis was, I've got a quote here from Robert Peston, who was in very exuberant mood last September. And on his blog he announced, if we want to avoid future financial crises that impoverish us all, we've got to pin our hopes on the effectiveness of these new rules. What was he getting so excited about? Basel III, the new increases in capital requirements. Now, again, this is something you see through history, these attempts to try and make the financial system safer by getting banks to hold on to more capital. And it's got this intuitive plausibility. Our banks ran out of capital and had to be saved. If they had more capital, they wouldn't be saved. They wouldn't need to be saved. The problem that begs, the question that begs, is the great philosophical question of the ages, and I don't think anything has yet been answered, which is, how long is a piece of string? Because how much is enough capital? Lehman Brothers, the bank that went down, that started the whole crisis, had much, much higher than the regulatory requirements then and under Basel III. So to say the banks need to hold more capital, I don't think answers the question. And then secondly, if you get banks to hold more capital, what's the next effect? Well, one is that it makes it much harder for banks to lend, and that's one of the issues we're having to confront. But more importantly, it creates distortions in banks' behaviour. And this is what we saw a lot throughout history. When you try and over-regulate the banking sector, you get displacement. Banks try to find ways around the rules, and you actually have to make the system any safer. So I would describe Basel III as a bit like the Maginot Line. Potentially very expensive and very easily bypassed come the next crisis. More capital is not a simple solution to the problems of the financial sector. The third one that's really on the table, of course, is what the Sykes Commission is deliberating about, which is the separation of retail and investment banking. And this has had a very powerful champion in the British economist John Kay. Matthew has written books with him. His work has been a huge inspiration for us. And he says, you know, let's completely separate off the public utility basic banking service and protect that from the casino capitalism of the investment banks. That way, if the investment banks go down, our public utility will be protected. That's the way to do it. And John's argument is based on a lot of his work in the past about economic regulation. And he says, you know, what you've got to do is regulate structure. And the only structural regulation that's going to work for the banking sector is going to be to do the separation of split. Now, I think we agree with him that pinning our hopes on supervising the behaviour of the banks is very, very difficult, and there has been a failure in our regulation there. But I think he misdiagnoses the problem by talking about the separation of investment and retail banking. Because again, this has been tried in different forms throughout history in many ways. But what you find is that you create a structural separation, and then that displaces activity elsewhere to a different part of the financial system, and you find the risk just growing up somewhere that's less regulated. So the idea that there's a safe haven by creating these big walls in the financial system, I just feel it's naive, it's not actually going to protect us. And I think Mervyn King actually described some of the problems with this. When he was looking at his report on financial stability, he described this very problem. Is this going to be protecting the financial system in the future, even if it works now? What's going to be the knock-on effect of the displacement to other parts of the financial system? So I think there are some big ideas on the table, but I think they're potentially misleading ideas that are damaging. And as Matthew said, the real fundamental problem that we had was this toxic idea of the efficient market hypothesis that drove so many of our structures towards seeing short-term performance as being the sole measure of value and success in a capitalist economy. And what we've done is created a system of institutions and information that's based on that short-termist paradigm. So the systemic change we need is dismantling all those parts of our system that lock in short-termism, and instead we have to replace that with new forms of long-termism in finance. And that's what Matthew's going to talk about now, and those changes to corporate governance and other structures that can build a much more long-term attitude and approach in our capitalism.
So, I mean, the first thing to say is that one of the consequences of pursuing some of these policy ideas towards the banking system that have been talked about, is likely to be that we harm the City of London. Now, many people have said, well, okay, we should have learned our lesson, we shouldn't have relied so much on the City of London as part of our economy. Having just been in Davos for the past week at the World Economic Forum, I've just come away with a sense of the enormous opportunities there are going to be for wealth creation through technology change and the emergence of countries like China and India over the next 10 years. And one of the key challenges in that process is going to be getting the capital to the right people and making sure that capital is well invested. And we actually have great bankers here in Britain who would benefit very much from that growth phase. And it would be an irony, a case of cutting off our noses to spite our faces, if we actually go into this sort of nostalgia for the manufacturing industrial revolution and actually drive banks like HSBC and Standard Chartered away. In saying that, I'm very clear that we do need change in the way the banking system behaves. But as I say, I think the misbehaviour, the failure of the banking system is a symptom, not a cause. The underlying cause lies in our investment institutions and in our attitude towards our own money and how it's put to work. I'm going to give you a mea culpa here as a journalist, and I think many journalists feel that we were to some extent contributors in a way to some of the hysteria in the bubble era and also to some of the panic after the bubble burst. I interviewed Dick Fold, the chief executive of Lehman Brothers, on many occasions, and with hindsight I'm struck by two things. The first is that he himself was unaware of what deep trouble Lehman Brothers was in. He's someone whose own personal myth was very much about how he was a man who really understood the markets. He had saved this bank before from going down in the previous debt crisis. He was going to save it again. The man was just out of touch about his own risks he was taking. The second thing was that Lehman Brothers had none of the, it would have been ticked by none of the boxes that the current proposals are trying to force us all to tick. It wasn't a universal bank, it was just an investment bank. It was smaller than what the breakup rules would be. And it had an incredibly well-designed long-term incentive structure for its senior management. So Fold was heavily, his performance was heavily linked to the long-term performance of Lehman Brothers. What it failed on, and where I failed to ask the right question, was that its board of directors was consistently rated D by the corporate governance activists. It had a retired actress who I think made her best film was Caddyshack, and it had a Broadway impresario and a whole load of other people who you could guarantee were not going to challenge the chief executive in any serious way. Now, that board was well known to be dysfunctional. I, as a journalist, it never occurred to me to ask, did he consider that a risk factor for his bank? It never actually occurred to any of the shareholders that I asked before interviews, what should I ask him about his bank? It clearly didn't occur to any of the other banks in the system that did lots of business with Lehman Brothers that this was a risk factor, nor did it occur to anyone in the regulatory system to be a problem. I guess the word corporate governance immediately causes people to drop down dead with boredom. And yet, that fundamentally is the system that is supposed to be making sure that our money, as ordinary savers, is actually put to work to act in our long-term interest, to provide us all with a good income in retirement. And it seems to us that one of the real problems at the heart of our system is that we've created these vast, unaccountable investment institutions who are rewarding their own people for very short-term performance and who are investing our money in ways that take no interest in what we want, in companies that are not helping to build the kind of society, sustainable society that we would like to live in. And that the time has come to really change that, to reorientate those investment institutions to act in our long-term interests. Now, obviously you can't, there's a question about what the long-term means, and Keynes famously said in the long term we're all dead, but clearly the current obsession with short-term performance is a catastrophic mistake, and we need to figure out how do we make these institutions properly accountable. There are a whole range of ideas that we have in the book to do this, including changing the law on what it means to be a responsible fiduciary, so that you are required to go through some efforts to make sure that you are voting your shares, taking some interest in who's running the company and whether the board is working properly. We'd also like to see much greater dialogue with reporting back to shareholders about why you're doing what you're doing, reporting back to us as the end investors. We think that is where the real problem is. We're seeing some signs of encouragement with the stewardship code that the investors, institutional investors are coming up with. But generally, we're kind of puzzled that that whole part of the story is being ignored in the discussion that has so far gone on. If the institutional investors were doing their job properly, the banks who are working for those institutional investors would be paying their people differently. They would be using money very differently. They would be taking much less risk because the risks they've taken are not in our interests. So we have some ideas there. I'm going to hand back to Mike to talk a bit more about the big society.
Those of you who are following the big society on Twitter will know that today the big society is having an enormous crisis because one man is going to do 1 day less volunteering a week. This is Lord Nat Way, the government's advisor of the big society, was announced that his voluntary time on the big society has been cut from 3 days to 2, and suddenly we're all in crisis. I think it's a good example of how ridiculous the debate has got about the big society. And I think in part it's because it's such a political agenda and it's such a good thing to attack for the left. And it is the fault of the owners of the big society for failing to define it in any way that's not complete wood. Matthew and I had dinner with a Conservative MP on Monday night, and we challenged him to, in 100 words or less, tell us what the big society meant. We gave him a few drinks, we offered to go first. He still wouldn't stand up and give us the big society in 100 words. And actually, to be fair, that might not be the right question. I think a much more meaningful question to ask of the big society is how will the big society's success be judged in 4 or 5 years' time? And I think if the government could actually articulate something meaningful about that, then we would know something about what the big society is really all about. Because the danger is we come to the next election and we will just get a whole string of stories of someone walked their neighbour's dog, someone helped someone up the stairs with a pushchair, fine, that's nice. But that does not tell us anything about how our society has become better. So I think it's ironically, I think there's one of David Cameron's other derided projects, the Gross National Happiness Project, is actually onto something in some way, which is figuring out some way of measuring the well-being of our country beyond the simple confines of GDP per capita, that actually captures the changes in our welfare that the big society says it's all about, has got to be part of the agenda. It has to be crucial. It has to be crucial to actually making the big society a success in some ways. And I think if you ask that question, then that really lays down a challenge to what the big society currently is. Because, like it or not, I think it's associated still with Toby Young setting up free schools, which will be more posh schools for more posh kids, rather than anything that's going to transform our education system. It will be about maybe people doing volunteering. Now, we know volunteering is very good evidence to say that volunteering makes people happy. Maybe it will make us happier, but can voluntarism really transform our society in some fundamental way and deal with the social impact of the cuts in public expenditure? Is the big society about mutual societies and co-ops? Well, I think there is something interesting there. But the thought that our whole society, our whole economy is going to be turned into some mutual-run cooperative society, I think is a fantasy. So I think there are these deep problems in that all the examples are being offered of the big society, though individually they might be nice, to me don't seem to sum up into the kind of scale of transformation that we're looking for. And ironically, having written a book called Capitalism, you might think that we'd be saying that giving is the solution. But one of the most important things that Bill Gates said to us when we interviewed him for Capitalism was that the Gates Foundation is just a tiny, tiny organisation. And what he meant by that was with all its billions, its resources were so small compared to those of governments and the private sector, that the sweet spot for his philanthropy was how you leveraged the resources of government and the private sector to create really scalable solutions that actually solved problems and weren't just a bit of charity as a nod to a problem. And that's exactly the problem that big society faces. And I think one of the most fundamental problems that big society faces is some of the philosophical roots that claim for it, particularly Philip Long's Red Toryism. I think this third wayism of the right that tries to criticise both government and market has ended up in this very strange position of being almost sort of more anti-capitalist than even the Labour Party of the 1970s or 80s. It's quite extraordinary, some of the things in his writings against business. And I think it's one of the reasons why the government's strategy on business in the big society has been so stunted at the moment. I mean, in fact, you could describe the government's policy on business in the big society as declared as being a policy of Dame Geld, extracting money out of the city through its crimes, to be left alone. I mean, that seems to be the large push on giving, is extracting money from the city. The FT was reporting yesterday there was an attempt to extract free advertising from the media industry, and the media industry, not feeling under so much threat, were happy to say go away. So if it's all about just trying to get sort of indirectly tax business by making it cough up for crimes, that's a very poor way and an unsustainable and inefficient way of delivering the big society. Because we think there's a much bigger opportunity, which is linked to this transformation in capitalism about thinking longer term. Because if business is thinking longer term, then that opens up space for discussion about how business and finance in particular can be part of solving social problems. And I'll give you an example. There's a great organisation operating in East London called Fair Finance. It's a microfinance institution. It's working on financial exclusion and debt advice. And the great thing about Fair Finance is that its goal is to get to scale by leveraging commercial investment. So many microfinance institutions are hobbled by the fact they're reliant on charitable donations for the money to lend. So they don't have any discipline to really push their efficiency, nor do they ever get access to the capital to get to scale. Now what Fair Finance is trying to do by being a social business, accessing private capital markets, is get to scale quickly. So it's not just serving people in East London, the East of England, but actually the whole country. And I think it's a fantastic experiment, and there are many other areas where this social business model with commercial backing by long-term financial institutions could have an enormous impact. Now, one of the government's ideas to tackle this is the big society bank. And I think that actually does illustrate the problem, is that my fear is the big society bank, again, is part of this deal with the city to extract capital from the city to then start lending to the social sector. When actually what the big society bank, if it's going to be successful, has got to do is it's got to be a way of helping to leverage money from the private sector towards these kind of social businesses. And if it can do that and start to access the tens, hundreds of millions, billions of the private capital markets for building a better, bigger society, then there's a potential for a much greater impact. So that's one aspect of the big society that I think needs much more development. The other one I would say is exactly what Matthew was saying about the need for more accountability for business and investment. That needs active, engaged citizens. Well, why can that not be part of the big society agenda? Because remember, they work for us. Most of our businesses are owned by institutional investors who are holding our money. So ultimately, it's our pension funds, our life insurance companies have a huge say in how our economy is run. But how often do we ask our pension funds any question apart from how much am I going to get? Now, that's what the reforms that Matthew was talking about, together with engaged citizenry, is a way to start having that conversation, that we can start asking questions about how our money is being used and having a say about the kind of capitalism and the kind of business that we want. And I think if the big society can do that, then there's a potential real leverage point for it. Now, this may sound idealistic of what we call citizen capitalism, but look back 25 years, 30 years of the ethical consumer movement. I remember Matthew pouring me the most disgusting cup of coffee in the world 25 years ago, and then bringing out his £7 tin of fair trade coffee from Tanzania. You know, fair trade, those kind of ideas started small, but have grown and grown and grown. And ethical consumerism is having a huge influence on today's corporations. So we've become very smart consumers but we're actually not very active or smart on how our money is used as capital. So if we can start to develop ourselves in that side, if the big society can leave us in that way, there's an enormous potential. Under a previous Conservative Prime Minister, we had the popular capitalism of Tell Sid, the gas privatisation advertising campaign that was basically telling the public, we've got tenors for sale, you can buy them for £5. That wasn't a very rich form of popular capitalism. Maybe a big society popular capitalism is actually about saying, you do have something to do, you do have a responsibility, and there's something in it for you in building the kind of society that you want to live in, and potentially building a big society that actually means something. Thank you.
Thank you very much, Michael and Matthew. That was really interesting. It's nice to actually get a chance to talk a little bit about issues I've had an opportunity to read already. I might take speakers as a chairman prerogative and ask you first a little bit about what you said. You said about the blind alley, the separation of two different types of banking, retail and investment side. And so from our perspective, we've argued quite heavily thus far to try and find ways to get both depositors and bank creditors more involved in understanding and trying to enforce the right methods of management on the boards of those sort of major financial institutions. And so far it's been an interesting response we've had, because a lot of people are politically find it very difficult to allow depositors to lose funds, even though asking someone to think about themselves and asking them to think whether or not the bank they're putting their money with is the right institution to hold it. And also for bank creditors, whether or not they are just accepting that, given the implicit government bailouts, they're going to be protected. I mean, do you think those are positive ideas, or what would you suggest is the right way to resolve that difficulty without necessarily resorting to a full separation of retail and investment banking?
I mean, just on the question of deposit protection, I think one of the very instructive stories we looked at was the 1907 financial crisis in the US, which started in the banking trusts. And the banking trusts were a much less regulated part of the banking system. So the national banks, as they were called, were regulated. And there wasn't deposit protection, but they had a system of mutual assurance among the different banks. So essentially deposits were protected. If you put your money in a banking trust, you knew your money wasn't protected, but because it could be invested in stocks and shares and other things, you got a better return. Everyone knew this. In a national bank, you're protected. In a banking trust, you're not. The crisis starts in the banking trusts. They should be wiped out. It starts to spill over into the national banks. And in the end, it's JP Morgan as a private citizen who actually has to bail out the financial system. So I think, and that we see this again with the savings and loan crisis in the US. You can try and create these walls, but I think once the public feels that its deposits are threatened, you'll suddenly find them demanding different bits of the financial system protected. And I think it's that political dimension of it, which is what makes financial regulation so hard, and so hard to draw those lines and barriers between different bits of the financial system.
Perfect. Any other questions from the audience? We've got a roving microphone, so perhaps let's start. I'll take them in three, so there, and then behind the lady in the green.
Hello, my name is Janet Williamson. I'm from the TUC, and just a sort of opening comment. Don't agree with your analysis of the cuts, but put that completely to one side. Just a kind of comment on your mea culpa. I don't imagine the Economist, you know, the kind of publications of the TUC are very high up the Economist reading list, but if you had been looking at our work over the kind of previous decade, you would see that we'd written extensively about short-termism in capital markets and the problems of short-termism within institutional investors and so on. So I think those ideas and that analysis was out there, but wasn't being picked up by the mainstream financial press at all. So I think for me there's something very interesting about the fact that a lot of the ideas which have now gained kind of currency and the questions being asked about short-termism, including in your book, were around before, but weren't being listened to by kind of mainstream financial journalists. But I wanted to come back to the kind of the central point about short-termism within financial institutions and just get a bit more from you about what your proposed proposals for reform are. I think there has been actually more emphasis upon that area than there has been, for 10 or 15 years. And there was a report by David Walker into bank governance, which took a certain way, and now there's been Vince Cable's long-termism complication, which I imagine you fed into, I hope so. So there are people kind of looking at these things now. And one of the central problems that you kind of come back to is the fact that, you talked about pension funds, but pension funds only actually own about sort of 15 or 16% now of the stock market. Other institutional investors about the same amount, and then the rest of it is, a whole mix of other financial organisations, sovereign wealth funds, and so on and so forth. And I'd just like to hear a bit more about what you would put in place to tackle the problems of short-termism.
Perhaps let's address that one. That was quite a meaty question, so let's address that one first.
Okay. On the short-termism point, I don't. My mea culpa is somewhat limited. I think I have written about problems of short-termism before. I think the issue is really that, and Greenspan actually, in his one confession of error that he's given since the crash, said that his assumption was that banks basically understood their own self-interest and would act in their own self-interest, and that he had been wrong in that faith. And I think that is why many of us felt that although there were there was a lot of worrying evidence around short-termism, that fundamentally it wouldn't bring the system to its knees in the way that it did. Although we still wanted those problems of short-termism to be addressed, they just became, the extent to which they're damaging has become much, much clearer as a result of that crisis, that there was really very few people, if any, in the system who seemed to have any long-term motivations at all. The ratings agencies were supposed to be acting in a long-term interest. They seemed to sell their reputation very cheaply. There's a culture which we write about in the book called IDG, YDG, I'll be gone, you'll be gone, which dominated the city. I think that part of what needs to be done is a change in the law. Institutional investors have been able to claim that they've been behaving in a prudent way as they've invested our money, simply by saying that they had held a diversified portfolio of shares. They could get away with not voting those shares. They could get away with not disclosing how they voted when they did vote. There was no pressure on them to ask any questions of the companies in which they invested about what their long-term strategies were, what risks they were running. Annual general meetings where supposedly corporate management is supposed to be held to account by shareholders are a joke. Most corporate CEOs try to make those as difficult to attend and as uninteresting as possible. Our dream in the book, there are no easy answers to get there, would be that every institutional investment company was a kind of institutional version of Warren Buffett, who each year hosts all the shareholders in his investment company in Omaha, Nebraska, has a day where the companies in which they invested are all showing up to talk about what they do and show off their products, and in which he takes a lot of questions about his strategy, including questions, a 2.5-hour session of questions from journalists. Why isn't that the norm for every pension fund? And why are we as a public not demanding that? I think that's where we would like to get to, and I think we need to have a serious debate about how we do that, because there are all sorts of issues around. One of the things this crisis clearly highlighted was that most of us are fools with our money. We bought into many of the myths that things were going terribly well and our house price would go up forever and all those sorts of things. Our pensions were going to be fantastic and so forth. And now I think we've all had to come to terms with different levels of financial illiteracy of our own, and we need to address that. Getting a more economically competent citizenry, which is how we rather long-windedly describe it in the book, and it has to be a priority for any long-term reform of our system. And it's not very easy to know how you do that, but that has to be something we take seriously as a priority.
Perfect. Yes, sorry, that lady in the fourth row.
Hi, my name's Laura Wilson from the Cabinet Office. Part of my unit is working on trying to establish what the big society bank is going to look like. So we very much want to have an institution that does have a long-term partnership with the city and doesn't see it as a cash cow like that. So we're particularly interested in supporting social enterprises and building that relationship there. But I kind of we always want to get a fundamental tension on this. That we're wanting big financial institutions to invest in good high-risk institutions. But this is a sector that's kind of been beaten over the head investing in bad high-risk institutions with lots of bad debt. So how do we resolve that tension? How do we define what is a good high-risk and what's a bad high-risk institution? How can we build that narrative to engage with the city?
Okay, I'll just take those two next to each other. Did you ever factor in the fact that acting in a short-term fashion might actually have a real incentive, which is that people got fabulously wealthy for 10 years at least? And that might be a good reason why people act in a short-term interest. And actually, isn't that simply about UK and US forms of capitalism? So if we look to Europe, our investment rates in the UK and in the US are incredibly low as in investment rates in capital. It's sort of something like 5%, and has been for that's the long-term average. But in Europe, they're lots higher. So doesn't that say something about Anglo-Saxon capitalism as opposed to other forms of capitalism? Because obviously there's not just one. And I guess one other question is how do you address the issue of, well, I've sort of mentioned that, the issue of fairness of sort of bailing out banks, again, while people were getting fabulously wealthy, and still remain so, obviously, because there is that tension, politically speaking, between those who think that it's incredibly unfair that this has happened in regards to risk and reward. And the third part, in terms of mutualism, what would you suggest in terms of the sell-offs that are happening now with either forests or the Dover port, for example, as written by Tristan Hunt in today's Guardian? That actually there could be a case for selling these things off to communities directly rather than, and giving them a sort of making an unlevel playing field, if you want, to give communities first buy-in, rather than simply having it open to anyone to, for example, from either here or even Dubai. I think we'll probably stop there with, seeing as there are quite a few questions embedded in there. No, don't worry. Which one of you would like to tackle short-termism from sort of, well, the big society banks, perhaps?
So I mean, this big society bank, I mean, there is this problem, and it's just, especially if one's trying to cage the lending and risk-taking of the financial sector, you're then constraining the risk of the risk appetite for investing in some of these things. And if you take something like a microfinance institution, it's all about taking people who are not creditworthy and then working with them as a whole to actually produce quite investable products. But taking the lesson from securitization, banks would therefore want to look at the underlying assets and they'd say, it's not creditworthy people, therefore I can't invest in you. So I think this is why there's got to be this link between that big society agenda and this broader question about long-termism and financial reform. That if you reform the city in a way that it isn't about doing financial innovation, it isn't about risk-taking, it can't fulfill those roles. If you don't reform the city in a way that you make the ability to make long-term investment decisions like that possible, then you won't have a source of capital. So again, this is why we link these two issues. You can't do it on its own, absolutely. And that's why the financial reform, the long-termism reform, has got to be part of the agenda that supports big society and vice versa.
Yeah, on the issue of banker bonuses and so forth, and these people getting very, very rich for doing short-term things, I mean, those are precisely the symptoms that we're talking about. They are symptoms of a failure of corporate governance and a failure of the investment institutions to actually hold to account the people who they're employing. Now, of course it is unfair. I think one of the ethical things that has changed, I think, in the debate, and which I see as a sign of hope, is that prior to the crisis, it was just about possible to get up in the city and claim you were doing God's work with a straight face. You could tell yourself that thanks to the efficient market hypothesis and various other aspects of modern finance, you were helping to spread risk better around the system and make sure that Granny's pension was actually going to be higher than it would have been otherwise. Now, I think what's clearly been revealed by the crisis is that that was not the case. you know, that clearly there was a degree to which people were privatising gains and socialising losses, and you know, that does need to change. The question is, how do we change it? And the scenario of breaking up banks doesn't seem to me to do anything about that. The scenario of governments trying to set bonus plans seems to me a micromanagement that is almost bound to be incapable of succeeding, because people will always find ways around any attempt to stop pay in that way. So ultimately, it seems to me you do need to enlist the self-interest of capital, and it's our capital, you know, to actually assert itself and say we don't want to see so much of our wealth being dispersed to these people for doing stuff that is not in our interests. And unfortunately, many of the institutional investors are also rewarded fabulously well on very short-term contracts. Now, we are not gifted, unfortunately, by any leaders in the city who seem to have any ability to communicate to the public in a way that makes us feel even remotely sympathetic to what they're saying. And you know, we argued very strongly, based on our philanthropic capitalism book, that the first thing that ought to happen was that all those banks that were bailed out in various ways, including Goldman Sachs, ought to give away all their bonuses the first year of the crisis, and we got roundly condemned for our naivety. But I think as a gesture of recognising that the world had changed, that would have actually gone a long way towards at least giving them, you know, being a genuine act of contrition that might have actually helped to shape a more constructive conversation about how we redesign capitalism as it is. They've done everything they possibly can to make us hate them by being as grudging as possible when they are finally forced to apologise, and by you know, doing nothing to change the way they operate their businesses to make us feel that they're in any way more interested in putting our money to work in a more long-term fashion. So I think there is a real problem there of leadership, and we keep urging the leaders of the city and Wall Street to actually take a different tack, but unfortunately it seems to be going the other way. In Davos last week, Sarkozy was making some points about the failure of the banking system, and Jamie Dimon, the head of JP Morgan, actually stood up and argued with him and got roundly cheered by the other bankers in the audience, so they seem to be getting more confident about their position rather than less.
And what do you make of the suggestion that the shortism was driven by Anglo-Saxon style capitalism rather than, say, it's European? Or
well, I mean, I think in many ways aspects of Credit Lyonnais, and Credit Lyonnais had a lot of people in there who did some pretty dubious things that, because they were getting rich on the back of that. I think Deutsche Bank in some ways was operating a bit like a hedge fund at certain times. So I think that in fact continental capitalism had become more Anglo-Saxon in nature over the last 20 years, and because they in different ways bought into the same toxic idea around the way the market works. So I do think we are talking about a movement away from you know, the kind of trading systems that we've had where company shares get traded every 3 or 4 months, to ones where people are more long-term holders of shares, where they build longer-term relationships with the companies. And you know, I guess Germany used to have a system a bit more like that, although it wasn't clear it was going to work in the long run.
And Michael, perhaps on the mutualism question, about whether or not we should be trying to have an unlevel playing field for kind of communities to get involved with investment.
Yeah, I mean, this is, I think, one of the problems we have with the mutualism agenda, I think, is that I'm not quite sure what it is. You know, what goal is it actually trying to achieve? Is just local control what we're trying to achieve, or are we trying to find more effective management solutions? Is mutuals different from the role of maybe having private companies? That's often the worry that private companies are going to take over some public services. So I think I just find that the mutualism stuff, it's not clear to me that it's been defined where it's going to work and where it's not going to work. And it's been treated as this is the solution because it's both local and it's participatory and it's not business and capitalism and therefore it's wonderful. Whereas I think it's got a role, but not defined well enough yet, I feel.
Okay, sorry, let me just go back to that one at the back and then one at the front here.
Ron Dowler from the Industry Forum. I think that really puzzles me is why the banking sector in total isn't regarded as a massive case of market failure. If you look at simple economic theory. If you've got a sector where all the companies are making massive profits and paying very well, you get new entrants, profits come down, and salaries presumably come down and equalises. That does not happen in banking. It doesn't seem to happen. And there must be a good reason. I wonder if it's a question of puzzle reason. The truth is, they didn't have as much money. They only did interrupted. Some of the problems would go away. But the banking sector is now taking like 40% of corporate profits worldwide. And having a massive effect on investment in the industry sector worldwide.
Sorry, can you speak up a little bit with the background noise?
Well, basically the question is why aren't banks regarded as a market failure problem, where you get new entrants to bring down the costs and profit.
Okay, great. And one, perhaps.
Paul Nicholson, Sykes 2000 Trust. I work with the most poor members of our society when they can't pay their rent and their council tax, when they're hanging in the welfare system. And the kind of narrative which I always ask economists about is that back in the 1980s there was a deregulation of lending and a deregulation of rent control. And tons and tons of money flooded into a market in short supply. So house prices went up, and so did rents. And so inevitably did housing benefit up to about 21 billion a year. And this was an entire collapse of the system. And yet the people who actually paid the price are the people I work with. The housing benefit caps are catastrophic. They're going to force people to move, they're going to put them into temporary accommodation, they're going to put them into overcrowded accommodation. The other 22 caps in welfare are equally. So how can, in your designing of a better capitalism, design a capitalism which doesn't do that to the poorest, and does actually bring them into a reasonable economic standard of living as a matter of policy? And I also campaign for the London living wage, and that is designed to have taken into account how much of a decent diet is and how much you need in order to travel in London. The national minimum wage isn't. The banks, by the way, have been very good about the London living wage, and they're paying it. And I enjoy campaigning and shouting on doorsteps about that. That's my problem, and the problem of the people we serve.
So which one of you would like to tackle the question about whether the banking sector was market failure?
I mean, I think there are elements of market failure in the banking sector. I think there are bits of it that have worked spectacularly well. And I think part of the problem we have is that there's been because the overall system collapsed and had to be rescued, that we're tarring the entire system with the same brush. Part of what we're arguing for in the book is that we need to be much more thoughtful in understanding what works and what doesn't work, what went wrong, what didn't go wrong, and that we need to have new solutions to problems that emerge. And the same would apply, I think, across the board. I think what has been demonstrated beyond all argument by this crisis is that if you simply unleash the markets, deregulate everything, have regulators who don't really think it's their job to actually intervene, that the markets do not take care of themselves, they do not take care of society, they go in all sorts of directions and can cause catastrophic consequences. So we need to recognise that, but at the same time, in our work and looking around the world, the reason we shifted from a very government-dominated system to one where the markets were given a much greater role was because governments proved to have a lot of elements of failure in them as well. Not least, this is where we like the big society as a potential solution to a lot of problems. It's very bad at social innovation. Governments seem to have terrible risk aversion when it comes to experimentation with taxpayers' money, for obvious political reasons. And so we think that philanthropic capitalism, and particularly when it focuses on social entrepreneurs piloting different approaches to things and then government finding ways to help scale things up. That actually is a more, may produce better social innovation. So part of our message is that we need to actually rethink both government and capitalism and have this less sort of ideological view that markets are either great or terrible, which has sort of cursed us for the last century or two.
And Michael, how are we going to include the poorest in your new vision of capitalism?
Yeah, obviously there's a real fear that these cuts in public expenditure are going to have an enormous impact on the poor. But I think, I worked in government for 12 years until a couple of years ago, and I think what I saw in government was that as much as we had a bubble in the financial markets, we've also gone through a period where there's been a bubble in government. We had a robustly growing economy that was yielding a lot of tax revenue, a government that was willing to keep pushing up the share of government in the economy to try and tackle some of our most serious social problems. And if you look at issues like child poverty, the return on that investment was actually pretty low. And I think this is the point that Matthew was making. I think was that, sometimes I feel that if you're committed to the poor, you therefore have to be saying the solution has to be government. And I think my concern is that we really need, especially whether you agree with the pace of the cuts or not, have to find and innovate some new solutions that can really help people in these situations and do that in new and innovative ways. And I think a really big question is going to be the adjustment period. And I think that is a real challenge. And then linked to that, I think there's a worry, therefore, that some of the negativism towards what business can do can sometimes be a problem. I was reading a piece by Tim Montgomery on the Conservative Home blog, where he was raising the standard as being a Tesco Tory opposed to the Red Tory. But there's a very good point to be made that sometimes supermarkets actually going into poorer areas are actually offering access to food of a better quality and a cheaper price compared to so what you've got then is sort of the localism. I think sometimes a tension with these things. I think there's a real problem about how do we innovate and find solutions, especially in these fiscally straitened times. And I think the debate that can only be about it's more government or less government doesn't really capture that.
I mean, just briefly to add to that, I mean, one of the ideas that we really like is the social impact bond, which is an idea really devised under Gordon Brown, but not actually, despite all his espousal of social investment, not actually properly funded and created until the coalition came in, because I think he preferred big government solutions. And the social impact bond, which provides private charities with the ability to raise a lot of capital contingent on them actually delivering real results that save taxpayers money and improve outcomes, is a really clever piece of financial innovation that we need to test out properly and see if it can be made to work. And I still fear that at the moment, partly because maybe it's an inheritance from the Labour Party, it may not be getting as much backing, including through the big society bank, as we'd like to see it have.
I'll take just two more questions so we don't run over. One here, and then the lady behind.
Hi, could you just briefly comment, when you've talked a lot about the outrage directed towards bankers as the architects of the financial crisis that you wrote about, what about consumers all over the world who over-levered themselves to unrealistic levels? I think we're all partly guilty of this, and actually created the underlying instruments that the bankers then took and proved their downfall. I mean, there's been an awful lot of, as I said, reaction against the providers of it, but what about the consumers?
And then just a question behind.
Finally, Claire Durkin, URS, US and Transglobal Energy and Engineering Company. I'd like to be looking to the future rather than to the past, because I think most of us in the room, because it's kind of, yes, that's right, would buy up to an awful lot of the analysis that you presented of where we are now. But where does it take us? The danger is that we end up looking at a world that is kind of, I don't know, Buddenbrooks versus the Big Short. And we can't go back, and nobody wants to go back to a Buddenbrooks. And we can't just get hung up on the fact that we had the Big Short. So where do we find the articulation and the leadership that you've indicated is necessary for the long-term myth that we need to create, that can link the capital markets in the city with the Manchesters and with the Birminghams, to create a much more coherent society for the next 20 years, not for the next 5 years. And are we not in danger of just creating nicer baubles rather than the vulgar baubles? And baubles aren't going to do it. We're just going to get bored and then we're going to look at the new baubles in the next 5 years. That's what we do. So how do we really enrich the narrative, get the leadership? And I don't mind whether it comes from government or the businesses or the city. It's got to come somewhere, and it has to be coherent, and it has to speak with confidence that can bring the societies with us. And I'm not seeing it yet.
Okay, thank you. Which one would you like to attack? Whether or not consumers over-borrowing should have more personal outrage at them?
Not only consumers. I mean, I think this actually ties back into the whole question about how we measure welfare, because in a sense, what we had for 20 years before the crash was this period where, especially people in the middle, were seeing, especially in America, weren't seeing much growth in their real incomes, but were compensating by taking on more debt and getting this sort of this gain from the supposedly increasing value of their capital assets that they were able to spend. So since that huge surge in the net indebtedness of our economy wasn't really counted as part of that total welfare calculation, as long as good old GDP was going upwards. And this is why we talk about in the book, GDP was invented in the UK and the US as a response to the Depression of the 1930s as an economic management tool. It was not, as you might think watching the news, handed down on tablets of stone. It's a tool to help us guide our decisions. And this is why we're saying that finding better tools to measure our economy is actually really important in this, to see how things are developing. Because yes, I mean, you're right, consumers were part of the bubble. But what I'm saying also is that it was very hard to see how that bubble was forming, given the economic data that we were using and relying on. Now, that doesn't mean that gross national happiness, as currently defined, is the answer. I think there's a lot of problems with that measure. But the idea of creating a better dashboard of measures on progress and how we're doing might help us to make better decisions in the future. And then just slightly approaching on the next question, I think then that's linked in, if you've got better measurements of national progress, better measurements of corporate performance, you then started to create those mechanisms that start to guide the economy and the society in a different direction. And I think that point about the information we rely on to make choices is absolutely crucial in the direction we're heading in.
Yes, I mean, to add to that, I mean, it does seem that part of the change in the narrative that hopefully our book will help people understand is that any politician that gets up and says GDP is going up, stock market's going up, profits are going up, and stops at that point and says therefore things are going in the right direction, they should be challenged, because we need to actually be looking at other measures alongside those numbers as to whether we're heading in the right direction. So hopefully the days when a politician can get away with just saying that are over. Another aspect of what we think is important is this notion that rather than where we could be heading, which is bashing the banks, bashing the city, breaking up the banks, saying let's get into manufacturing and compete with the Chinese on that. Rather than saying that, which seems a very counterproductive negative line, we should be saying there are real problems in the city. There's a lack of leadership, the wrong people are in charge, they're earning far too much money. But the way to solve that is for us to engage as citizens in capitalism, and therefore we think the missing ingredient, the missing character in David Cameron's Big Society agenda is this is Big Society Sid. It's the not the Sid that knocks over the postman, as you remember in the adverts from the 80s, to tell him about this tenner being on sale for $5, but actually Big Society Sid is an ethical consumer, someone who may do their ethical consuming at Tesco, in fact, because it's cheaper ethical consumption there, but also someone who is going to be engaged with how their money is invested, that they are going to be responsible about not getting into too much debt. They're going to be wanting to put their money into pension funds that are investing in a sustainable way for the long term. And I think the government can actually use changes in the law combined with the PR skills of, after all, a Prime Minister who used to be a PR man, to actually promote a very different view of how we as citizens engage in capitalism. Rather than being anti-capitalist, it should be citizen capitalism. And so if there's any big idea in our book, I think that's probably the biggest of them, that we need to end this era where we are, as citizens, are completely disengaged from capitalism and actually start engaging properly. I think is that our lot.
Yeah, no, that's
on that note, I'll just give a plug. We have got copies of the book here. We're selling them cheaper than you can get them anywhere else, I think, or certainly cheaper than you can get them in the nearest bookshop. At £12 for The Road from Ruin and £8 for Philanthro Capitalism. We have a website, roadfromruin.com, and we both tweet. If anyone wants to follow us on Twitter, I'm at Matt Bish, M-A-T-T-B-I-S-H, and Michael is at Shepley Green, S-H-E-P-L-E-Y-G-R-E-E-N. So, and we just, above all, hope that our book will be, something that really does promote some serious thinking and serious debate, because we do believe this is a great moment of opportunity for Britain, that if we get it right, we can be a role model for the world. If we get it wrong, we could be stuck in this mess for a very long time.
Thank you. So thank you so much. Thank you all so much for coming. We're so pleased again to Matthew for taking the time out to outline their ideas and also to take time to respond to some of the questions you all have raised. I have read both their books, so I can thoroughly suggest that you should, if your appetite's been whetted by today's discussion, you should get involved and actually look at their analysis in a little bit more detail. But yeah, very nice to see you all. Hope you'll be involved with Politics Change more in the future.